All right, so there was no big surprise from the RBI monetary policy today as expected. MPC did hike repo rate by 0.5% to 5.9%, and this is the highest level since April 2019, and this shows that the central bank is stepping up its fight against persistently high inflation. The MPC also lowered real GDP growth estimate for FY23 to 7% from 7.2%. Highlighting the economic situation, now Governor Das said we are amidst the third shock after COVID and Ukraine war, and this shock is of aggressive monetary policy. To discuss how will this monetary policy impact your EMI and how will RBI commentary change the future dynamics of the Indian economy, we have on board joining us Lakshmi Iyer, President and Chief Investment Officer and Head Products, Kotak Mahindra Asset Management, and Trideep Bhattacharya CIO-Equities, Edelweiss Mutual Fund. Welcome both of you. Lakshmi, first question obviously would be to you because there was no big surprise and as expected 50 BPS rate, but then the question now is what is the way going ahead?
Hi, good evening, Kavita. Yes, this announcement was pretty much in line with most of our expectations, and the undertone also where markets expected it to be a little bit negative, that did not happen. So it had more of a neutral undertone. Our sense is going forward, you will see a lot of data dependency driving the next course of RBI actions. Now, what I mean by data dependency is the incremental data that is largely, happening from the global front. Because if you see from the previous policy to now, there's hardly been any material domestic adverse development which actually warrants tighter rates. Inflation has been pretty much on the bend. So I think that's been the narrative which the central banker articulated quite well today, that incrementally, while we are edging towards a slightly more neutral rate, could there be just one more rate hike before the pause? I think that's going to be left to a larger extent on the incoming data.
Concern about falling rupee also, which did not look like a major concern in the commentary at least, but then we further go into this. I want to ask Trideep about the data that you just spoke about. Trideep, obviously the global markets are giving a direction to emerging markets out here, but then I want you to help us understand the FII trend. Is there more room for selling from their end? What is the trajectory so far has been like? And also, are you really concerned about growth slowdown right now?
So, hi, Kavita. Thanks for having me on the show. I think when you look at data, various types of data, right? So, first of all, inflation, the near-term inflation has part of it, or has had part of it driven by supply-side challenges and also logistic-related issues and some of the commodity prices which are now coming off the boil. So certain part of the inflation will certainly cool off towards the end of the year and maybe the first quarter of the year. So that will be kind of incrementally positive. However, where it stops continues to be high is something that we incrementally monitor and needs to be understood from a growth slowdown perspective. While it is inflation slowing down is a bit to cheer from an equity market standpoint, if it remains persistently still high or at a higher level, that could create a bit of growth slowdown. Now, at the moment, I would say that I am in the camp that inflation will cool off. But having said that, inflation will probably be higher than what we have seen in the last couple of years, simply because the economic growth historically coming out of a lockdown is of the higher side. And I would say that getting into the festive season, the data that we sort of see from the companies, of course, we will hear more in October and whatnot. But it's so far so good. I think particularly the urban demand, etc., is kind of holding up quite well, while rural continues to be a bit of a spot of bother. Coming on to, so basically fundamentally demand is still holding up, more skewed towards urban demand maybe, but still holding up. Coming on to FII behavior, to a certain extent, the FII behavior is anchored around what happens in global markets interest rates, partly because of their base there. And hence, particularly after the last Fed meeting, we've seen FIIs resorting to selling overall from that perspective. But I think what I draw comfort from is if you look at the earnings estimates from Indian corporate standpoint, they are still holding steady. in absolute terms. And if you look at in relative terms versus all the investment options that FIIs may have and domestics may have, I would say certainly the relative picture looks even better. So what I'm confident of is on a relative basis, as an investment option in India will continue to be a favorable one. In absolute term, whatever is happening globally will continue to be a bit of a headwind from an Indian equity market standpoint. That would be my starting comment, Kavita.
Don't you think it's just a matter of time? We really need to follow the kind of demand and consumption outlook coming up, because we can see, we can at least analyze maybe in the coming future, in a couple of months, in fact, that there will be a solid slowdown because of the rate hikes. You talk about different sectors. HDFC has increased retail prime lending rates by 50 BPS from October, and this will slowly just lead on to a more restrictive spending. How do you look at it? From what time onwards you think we should really keep a close eye on the demand outlook, consumption outlook, Trideep?
Great question. I would put it like this, that at the end of the day, the IRR of the projects that are getting funded by some of these rates is how we need to analyze the situation. If the IRR is materially higher than where the rates are, then maybe 50 to 75 basis point increase in rates don't alter the outcome of the project, and they will continue to invest in that direction. However, if the projects are kind of IRR, which is near about cost of capital, they will certainly slow down. At the moment, since the economic pickup that we are seeing in Indian economy is still in its incipient stage, I would say the IRR of the projects that are being funded by some of this credit growth that we have seen in the banks is a higher IRR in nature, and those will certainly continue. The marginal ones will probably slow down, but that is at the moment a small proportion of the overall credit demand. So yes, incrementally speaking, there'll be a bit of a slowdown, but on net balance, majority of the projects being higher IRR, which are getting IRR, which is coming for funding, will make the economic recovery continue to happen, maybe at a slower pace than what we have been used to earlier. Now, that's the first level thinking. The second level thinking is, did we not expect rates would go up? And certainly we did expect rates would go up. So hence, to a certain extent, entrepreneurs, when they plan their capex, would have budgeted in slightly higher cost of capital in their planning assumption as well. And I think versus that, what RBI did today, and so far what we have seen, the rate increases have not been materially higher. That's how I would put it. And hence say that not yet in terms of a material slowdown.
Lakshmi, now let's analyze this from depreciating rupee point of view also. Is it really a bigger concern? Because as per the commentary, we again bank on a lot of data to come ahead, and there was no specific level given of weakness per se. What do you have to say about the trajectory for rupee going ahead?
My sense is that the rupee is not going to significantly be away from the rest of the currency pack. And when I say rest of the currency pack, I'm talking about both the emerging market and the developed market currencies. So you see, the rupee has been a relatively better performer, though almost every currency has actually depreciated versus the dollar. Near term, there might be a small pullback. If you see the dollar index, it is displaying a little bit of weakness after having, a pillar-to-pillar kind of a strength. But I think once one goes back to fundamentals, and the US Fed is in no mood to stop right now. Every time there's a soundbite coming from one of the Federal Reserve governors, it's alluding to the fact that recession or slowdown doesn't really deter us from being the inflation vigilant. So in that kind of a scenario, it looks like the broader emerging pack currencies could remain vulnerable in the very near to medium term. And that effectively means that it could pose reasonably strong headwinds even for the rupee. It's also important to see that the foreign exchange reserves have been dipping. They're still okay, reasonably perched, but it's important to have a plan B. So while we did not get to hear much on the policy front today, I'm pretty sure the policymakers are working out what more they can do in terms of their arsenal to actually combat the power of the dollar if there were to be a scenario. So I think that's the outlook for the rupee at the current juncture seems to be a tad vulnerable.
Lakshmi, also can you explain the reason behind the range-bound movement of bonds? Because we were actually expecting it to rise up, but then especially the kind of less than expected borrowing data that came last evening. What is the trend ahead?
So, while the borrowing data, which means lesser supply in the second half of this financial year, is certainly good news, equally important is that we saw the potential dealing of the index inclusion. So for most market participants who are expecting it to be a slam dunk, it looks like it is going to be a little bit of more delayed gratification. Plus, we had an auction today, which actually the result of that came in a little bit higher. So towards the end of the market close, we actually saw some selling in the 10-year bond, which closed at around 7.4. Going forward, this actually could edge towards the higher end. Of course, a lot is a function of where we see the US Treasury, which almost went up to 4% and is trending at around 3.7 right now. But it's clearly evident that some more pressure on the bond yields can remain. It could be in a tight group for now, but it could edge towards the 7.45, 7.5 region and then try to play in that 15 to 20 basis points group.
All right. So, Trideep, now on the equity front, help us understand the kind of strategy and in terms of market exposure. If our investor, our viewer wants to go heavy right now in equity, would you recommend that? And if not, what would be the reason? And especially talking about mid cap and small cap, you think this is the time when you can go slightly bullish on these in these areas with the exposures here, considering you have a time horizon of say maybe 5 to 7 years. How are the valuations looking in these most volatile areas?
Yeah. So I would say that obviously as any equity investor or any investor who is looking to invest in equities should invest with a time horizon of 5 to 7 years. And if I were to look out 5 to 7 years in time, I think there are 2 or 3 things happening in the economy which doesn't get altered with what's happening in the very near term. And hence on net balance, I would be a buyer on dips. These 3 things would be that I think for the first time in the last decade or so, we have a decent chance of a capex cycle driven by private sector that might stand to happen. The amplitude of the growth we can sit and debate ad nauseum, but the fact that there would be a capex cycle is kind of, incremental high frequency data is showing so. Second, I think overall, the real estate sector or the household capex, it also seems to be kind of, coming off from the bottom. And we did a study on inventories to figure out that inventories all across India are at its all-time low, which generally bodes well for the real estate sector, which means genuinely good from an economic standpoint as it generates a lot of employment as well otherwise. So that's again will play out over the next 5 to 7 years. And third, for the first time in the last at least 3-4 years, the salary hikes have been decent in double digits. And in my opinion, if you give consumers a bit of time, might build out their earnings power a little bit. So on the back of all of these, and on the back of the fact that globally, probably headwinds are likely to continue over the next 6 to 12 months, I would say domestic cyclicals is the place to be. And that is where I think one would kind of be put an incremental rupee in if one were to invest money in equities today. And given what I just highlighted, the areas that we are relatively sanguine on include industrials, capital goods, lending part of the financials, and direct and indirect plays on real estate. Certainly, these 3 areas look to me that over the medium term would continue to do better. And I think for an investor taking an incremental exposure, not in one go, but in tranches over the next 3 to 6 months, might be a good way to take exposure to equity markets overall from a 5 to 7 year perspective.
All right, so staggered manner, if at all you want to increase your exposure in equity. Thank you so much, Lakshmi and Trideep, for breaking down the monetary policy for our viewers today. That will be all from your end. Thank you so much. But we will slip into a short break. But then, since we're talking about the monetary policy, you also have to understand how will it impact your EMI burden. This will be later on in the show, but then we have to slip into a short break. And after that, we'll explain you how are ULIPs becoming investor friendly. All this and more after this break.